Welcome to This Explainer. Today, we're putting on our detective hats to uncover the real story behind Molina Healthcare's second quarter 2026 results. You know, when a massive healthcare player drops their numbers, the headlines really only scratch the surface. So we're going to dig into the actual data to see the full picture.
Okay, let's just dive right in. The best clues always lie in the official, audited Form 10Q submitted directly to the SEC. There's absolutely no corporate spin here. It's just the raw, unfiltered truth of how Molina is operating, exactly where they're making their money, and where they're taking some hits.
Here is our roadmap for today. We'll be covering 1. The Q2 earnings shock. 2. Inside the income statement. 3. The segment breakdown. 4. The strategic Medicare pivot. And 5. Cash and balance sheet.
Section 1. The Q2 earnings shock. For the second quarter of 2026, Molina reported a net income of $60 million. Now, in isolation, $60 million sounds like a pretty healthy chunk of change, right? But in the world of large-cap managed care companies, a number is really only as good as the context surrounding it. And this particular number, well, it immediately raises an analytical eyebrow when we look at the historical data. When we compare that to the previous year, Q2 of 2025, net income plummeted from $255 million all the way down to just $60 million. That is a steep drop. I mean, it demands we ask the fundamental question: what happened? How does a healthcare giant see its profit compress that significantly in just 12 short months?
Section 2. Inside the income statement.
Let's piece this puzzle together from the consolidated statements of income. Notice the top line. Premium revenue decreased year over year from $10.86 billion to $10.24 billion. Now, Molina did actually manage to reduce their medical care costs down to $9.44 billion, and their total operating expenses fell as well. But here's the catch. The revenue drop outpaced those cost savings. Basically, they lost more on the top line than they saved on expenses, which severely squeezed their operating income and ultimately that net income.
To truly understand this squeeze, we have to talk about the medical care ratio, or MCR. This is literally the percentage of premium revenue a health insurer spends on actual medical care costs for its members. Keeping this balanced is exactly how a managed care company survives and profits. If premium revenue drops, but those medical costs don't drop proportionally, your MCR goes up and profit margins get absolutely crushed. It is the lifeblood metric of this entire business.
Section 3. The segment breakdown.
What's incredibly interesting here is just how heavily Molina relies on one specific sector. Medicaid is the absolute giant in the room, generating over $8 billion this quarter alone. That completely dwarfs Medicare at $1.56 billion and the marketplace at $628 million. So when analyzing Molina's financial health, we have to remember they are overwhelmingly a Medicaid-driven enterprise. Yet, ironically, it's that much smaller Medicare segment that caused the massive disruption to their net income this quarter.
Section 4. The strategic Medicare pivot.
The smoking gun for our earnings drop wasn't just a slight increase in hospital visits or some minor dip in membership. It was a massive $93 million impairment charge recorded during the first 6 months of 2026. This charge basically acted like an anvil on their operating expenses, dragging down the net income to that $60 million figure we saw earlier. But why? Why did they take a $93 million hit? The crucial point is found directly in Note 2 of the 10Q filing. Management states clearly, "We determined that the MAPD product does not align with our strategic shift to focus exclusively on dual-eligible members in Medicare, and we intend to exit this product for 2027. MAPD stands for Medicare Advantage Part D, so management is voluntarily taking this financial hit right now because they are completely changing their Medicare strategy. They're abandoning the MAPD market to laser-focus their resources exclusively on dual-eligible members. Those are the folks who qualify for both Medicare and Medicaid." And it's super important to understand how this charge actually works. That $93 million isn't actual cash flying out the door. Rather, it's an accounting write-down of intangible assets that they just aren't going to use anymore because they're exiting this product line. The filing breaks it down perfectly. They had to write off $62 million in contract rights and licenses, $27 million associated with a trade name, and $4 million in provider networks. Because the projected cash flows from the MAPD product won't exceed the carrying amount of these assets anymore, accounting rules require them to clear it off the books immediately.
Section 5. Cash and balance sheet.
Despite the Q2 earnings shock and despite the drop in premium revenue, Molina is actually sitting on a fortress of a balance sheet. As of the end of the quarter, they boast over $5.09 billion in cash, cash equivalents, and restricted cash. This proves that an accounting write-down, while definitely painful for the quarterly net income headline, hasn't actually drained their actual cash reserves. Now, why does this matter to anyone trying to understand this business? Well, this massive cash pile provides more than enough liquidity to handle current medical claims. At the end of the day, an insurance company needs cash to pay doctors and hospitals, right? Molina has plenty of it. More importantly, this liquidity allows management to comfortably execute their shift away from MAPD without having to scramble for capital or take on toxic debt. They can afford to take a short-term accounting loss to reposition the company for what they believe is a much more focused strategic future.
We'll leave you with this final thought. We've seen that the Q2 numbers took a severe hit, dropping from $255 million down to $60 million, driven largely by a voluntary $93 million impairment charge. But with over $5 billion in the bank and a massive Medicaid base, they are far from being in trouble. The real question is, will shedding the MAPD product and focusing exclusively on dual-eligible Medicare members ultimately position Molina for a leaner, more profitable future in 2027? Management certainly thinks so. But as always, we'll just have to let the future financial filings tell the rest of the story. Thanks for joining us on this explainer. Keep asking the right questions and keep looking at the data.